Welcome back to another Econ podcast with Mr. Hagan. And on this podcast, we continue talking about investing. And as always, this video is not designed to give investment advice. Its purpose is educational only. This video and other videos in this playlist are designed to teach about different theories of investing. If you want investment advice, please see a professional. All right, so on a previous video, I introduced the random walk theory and the efficient market hypothesis. And our general argument was that real events generate new information, new to us. Therefore, those events are random to us. Therefore, the price movements are random to us. The price movements connect back to the real event. That's true. But the real event generates new information that is random to us and therefore generates random movement in prices, at least from our perspective. So the question then becomes, what do we do as investors? So to start thinking about how we're going to manage this as investors, we need to think about the concept of total return. So let's talk a little bit about the concept of total return. So because stocks are random, we believe there's going to be the argument because stocks are random, we're going to argue that no one can consistently beat the stock market averages. Okay, that is what I mean by stock market averages. Well, if you were to add up the average return of of all the 10,000 publicly traded companies in the United States, you might get an average return, and history suggests that that average return is somewhere like 8 to 10%. We'll talk about those numbers later on. That you get like an 8 to 10% return per year over the long run on average. Okay? That would be like if you just owned all the stocks, every single company, you would get an average of 8 to 10% return. But no one, the random walk guys are going to argue, no one can consistently beat that by picking stocks themselves, by saying, well, I'm just going to invest in this airline company and I'm going to buy this computer company and I'm going to try to do better than the stock market average of 8 to 10% per year. Okay, we'll talk about that more in detail later, but our argument is going to be, or the random walk argument is going to be, that nobody can do this with consistency, because what companies do better or worse than the average is random. At least it's random to us. And so, as I was saying, what's an investor to do? Well, one thing that an investor can do is try to control risk. Investors can try to control risk, and we're going to spend a lot of time talking about risk. But in order to talk about risk, we first have to get back to talking about what I just mentioned. We have to first start to talk about the concept of total return. Now, what is risk? What is this thing that we're going to try to control? Risk is the chance that a stock might deviate from its normal or average total return. It's the risk that a stock might deviate from its normal or average total return. So here's that term, total return. See, if we're going to try to control risk, then we're going to have to be able to measure risk. And the question then becomes, how do we measure it? Well, we measure it looking at total return. So let's talk about total return so that we can understand better what I was talking about up here, where I said the average total return per year was 8 to 10%. What's that even mean? Or controlling risk, deviating from the normal or average total return. What do these words even mean? So to really understand all of this stuff that I'm talking about, we have to understand the concept of total return. So here's going to be a mathematical definition of total return. Total return is calculated by taking we're going to take, remember, there was two ways to make money in the stock market. You could make money by getting paid a dividend, and you could make money by capital gains. Capital gains means that the price went up. Okay? These are the two ways. Inside these blue parentheses are the two ways of making money in the market. And there's two ways of making money: were getting paid a dividend or capital gain. And the capital gain meant your sell price minus your purchase price. You bought it at one price and you sold it for another. So my total return is I take the total amount of money I got paid in dividends plus the total amount of money I made in capital gains through the increase in the share price. I divide that by the purchase price, the price that I paid to buy the stock in the first place, and I multiply that by 100. Okay? And that gives me the total return. That gives me the total return. So let's try this. Let's do a total return calculation. Let's do a total return example. So I'd ask you to do this example. Let's say that we purchase a stock for $110 per share. During the time that we own the stock, it pays a dividend of $7, and then we sell the stock for $114. So I'm just going to pause and have you calculate the total return, and then I will come back and calculate the total return and see how you did with it. Okay, I'll be back in a minute. All right, so I got a total return of 10%. Let's talk about how I got that number. How did I do this? So the total return, we go back to the formula that I just talked about. The total return is equal to the dividend paid per share. Okay, the dividend paid per share was $7. So we're going to record that right here. Okay, we got paid a dividend of $7 per share. Plus, we made a capital gain. We sold the stock for $114. We bought it for $110. So we would take $114 to calculate your capital gain. You take your sell price minus your buy price, and that's going to give you your capital gains. In this case, we made $4 for each share that we sold. So it's going to be plus 4. Notice all these numbers are per share. We got paid $7 per share dividend. Our share price went up per share, went up $4 per share. So we made $7 on the dividend. We made $4 on the capital gain, divided by our purchase price, which was $110. We purchased this company at $110, and then we multiply that by 100 in order to turn this into a percent. Okay, we multiply it by 100 to turn it into a percent. So we do the calculation, and so we have 7 plus 4 is 11. We made $11 divided by $110, which is what we paid, which was the purchase price of the stock. So we made, that's going to be 11 divided by 110 is 0.1 times 100 is 10%. We had a 10% return. Okay, what this is really calculating when we do this 10% return, what it's really calculating, what it's really capturing is how much money did we make? That's up here on the in the numerator. How much money did we make compared to how much we paid for the investment? Okay, that's what we're calculating when we do a total return. And then we're going to use this concept of total return to figure out how we can measure risk and therefore control risk in the stock market. Okay, this has been Mr. Hagan on another Econ podcast. Thanks for joining me, and we'll see you on the next podcast.